What's up everyone, it's Karthik with MoneyVest. Welcome on board for our market open live stream. Hope you all are doing great here, and just give me a thumbs up if the audio and the video is working well. We are back here on Monday morning for yet another crazy week in the market to wrap up the month of September, which has been very generous. Markets have cooperated quite a bit, although we are seeing a little bit of a risk-off environment here pre-market as a lot of crypto obviously is absolutely dumping right now. If you take a look at Ethereum, now down to 41.93, so a little bit under 4,200. Obviously coming down to a very key level of support at 4,000. Not to mention, of course, Bitcoin also selling off a little bit over 2%, down to now under $113,000 as well. So again, if you guys can see me, hear me, just give me a thumbs up. Just want to make sure the audio and the video is working well. And we are all set, all ready to go here for the week where Jerome Powell is also talking. So later this week, we've got Jay Powell, we've got GDP numbers, as well as inflation week, because that's going to be the Fed's preferred measure of inflation, such as the PCE and the core PCE, the personal consumption expenditure. And then, of course, earnings is essentially wrapped up with a lot of questions around all the executive orders signed by Donald Trump last week as well. Nvidia sitting at just under 176. So we're seeing a little bit of a pullback. Tesla is green, up over 1.3%. They just also got approved for robotaxis, I believe, in Arizona as well. And of course, we're seeing very nice momentum back up to 431 with Palantir down a little bit over 1%, with SoFi getting up to $30 in overnight trading. So if you come over to the 5-minute chart, you'll notice that we were at one point trading upwards of $30.75, and overnight trading, obviously we got up to as much as $30. And then since we've just been rolling over a little bit, down to 29.43. So we are slightly down about 27 basis points at the moment as well. So welcome on board, everyone. Again, thank you so much for joining. Give me a thumbs up if you are able to see me and hear me. I just want to make sure the audio and the video is good, and do me a favor and share this live stream with as many people as possible, with your traders, investors, friends, family, everybody, so we can have a very lively discussion for the market, and of course get ready for market open yet again. Volatility is higher, a little bit over 4.2% green, getting up to over 16 right now, although we have been dealing with a low volatility environment for a really long time. And then if you take a look at some of these stocks right here, which are the YouTube favorites, if I include for the extended hours, and then bring that over a little bit here, you'll notice that there are quite a few companies that are just absolutely pumping, such as Iron, up over 10%, ETHZ. There's also speculation that Tom Lee is getting involved with this company as well, up over 7.5%. Then we've got some other companies that are essentially selling off to as much as SBET down over 6%, BMNR down over 4%, Open Doors down over 4%. We got RGTI down almost 7%. With MicroStrategy down over 2%, Grabs down almost 2%, Oklo down over 2.7%, which has been on an insane run up, another 28% gain on Friday. It is also rolling over just a little bit pre-market as well. So that's where we are. Once again, thank you so much for joining. And we've got lots to discuss, of course. Trump's 100,000 H-1B fee sparks a global race to grab top talent as well. And as we know, on Friday, Donald Trump signed the revamp of the H-1B visa program that is widely regarded as an opportunity for the major economies. And we know that every year, 85,000 H-1Bs are issued. Most of those coming from major tech companies such as Amazon, Meta, Google, Microsoft, Apple. Those are the companies that are hiring top talent all over the world, specifically in the IT sector. So technology and finance are two of the biggest sectors that are getting a lot of these H-1Bs. But of course, a $100,000 fee is now quite substantial, right? That's a jump from $1,000, $1,500 to over $100,000. And that obviously is going to be a pretty massive expense for a lot of these companies. Of course, they also have deeper pockets, so a lot of these big tech companies can certainly pay for it, but it's really going to be hurting the SMBs, the small, medium businesses that don't necessarily have that much capital and are also going to be struggling to essentially find talent or people to work in those fields. And so obviously there's pros and cons. There's definitely a couple different ways to look at it. But I already shared my thoughts and my views in my previous update, where I did mention that I believe there would have been a merit system would have been better. Also, a percentage of your company's revenue would have been tiered, would have been a lot better as well, because a lot of these small medium businesses obviously cannot afford to pay $100,000 for an employee. Obviously if they want to sponsor them for an H-1B visa, so it's going to be hurting the smaller mid-size companies way more than the big tech companies. But also the big tech companies are the ones that are hiring, in substantial quantities as well, right? So most of those H-1B visas are going to those people. Okay, Srinivas, thank you so much for asking. I am doing well. I've got a flight tomorrow. From Boston. I had to reschedule from JFK to Boston. I really didn't want to drive back into the city, and also do have to go back a little bit earlier because we've got a family gathering back in India, so we'll be traveling long distances again. But I will be, of course, live and also bring you guys all the updates necessary on this market, which has been absolutely crazy. And as we know, has been driven by a lot of momentum. And in my yesterday's market update, I did want to also mention that we have to always be aware of where we are in this market cycle, right? Because markets are a pendulum. We swing from one end to the other. And right now we are in that end of greed and euphoria and easy money. And so we don't want to overstay our welcome. And we just want to be very careful with proper risk management and make sure that we are not holding on to something that doesn't have long-term value. If it's a momentum trade, treat it as a momentum trade, get in, get out, have proper stop losses. If it's a long-term investment, treat it as a long-term investment. It is a buy and hold with lots of potential long-term. So making that distinction is very, very important. Don't let a trade turn into an investment. And obviously don't let an investment turn into a quick trade for a quick buck. If you are looking at long-term compounders, the big money is made in holding, not in selling. It's made in patiently waiting and holding for those opportunities to flourish. And if you are trading, then obviously you want to be very, very careful with proper risk management as well. The last thing I want to see is a 10% loss get to a 50% loss or a 70% loss. That would be pretty disastrous and, of course, very, very difficult to come back out of. So very important things to always remember. And of course, we do have a lot of videos, a lot of tutorials, a lot of spreadsheets on our community, which you can access and, of course, utilize as well. How are you guys doing? I really want to know, how was the weekend? How are you doing? Very, very excited for another week here. As portfolios, of course, were hitting all-time highs. The markets were at an all-time high. And rate cutting cycle has begun. Another 2 rate cuts is what the market's pricing in, is what the Federal Reserve has told us. So 50 basis points. And already we're starting to see some changes, right? We're already starting to see rates come down. Lenders calling up for refinancing, lenders calling in for new mortgage applications. All that is going to start to kick up as rates continue to trend lower. So definitely lots and lots for us to discuss here. Thanks for streaming, Ray. Thanks for joining. If you want to do covered calls, do we need to have a minimum 100 stocks? So we need to have 100 shares of that stock if you are planning on doing covered calls. With cash secured puts, you need cash, right? It's pretty much self-explanatory. And both of these are covered, right? Or essentially secured, right? Those are in the words are in those strategies, right? Cash secured and covered calls. I don't necessarily do naked options because that can be very, very risky. So, in any market circumstance, you really want to avoid doing things that are going to take control away from you, okay? With any kind of investment that you ever make, you want to be in as much control as possible, right? You don't want to lose control over your own asset, right? Because if you do that, then that's not really the whole point, because the moment you start doing naked options, the moment you start taking on leverage, the moment you start taking on margin, that's where things start to get a little bit interesting, right? You're kind of giving up control for more leverage or for, there's a trade-off. And for me personally, I do want to be able to make my own decisions. I don't want a brokerage or a bank to make a decision for me. And so in those circumstances, I like to, be very, very careful that I'm doing covered calls and cash secured puts. I've got the collateral to cover my position. I'm not going to get a margin call. I'm not going to get forced out of my positions. I'm not going to get forced liquidated. A lot of those things matter a lot, right? They matter a lot. And so yes, covered call, you need to have 100 shares ready. in order to actually be able to sell one. If you sell a covered call, that's when things get very, very tricky, because if you do get in the money and you are obligated to deliver on 100 shares, which you don't have, then what happens? You essentially go short on that stock, right? The broker is going to essentially make a short position for you on that stock. And as we know, with any short position, your losses are uncapped. They can be infinite if the stock price keeps rising. So that's a very dangerous position. You obviously want to avoid that. Okay, is it time to let go of Google? So it really depends on your time horizon, whether it's a short-term trade or a long-term investment. Every kind of investment has to have an exit strategy before you even enter, right? That's one of the things that we talk about in investing and financial planning and trading in general, is every time you put money into something, you need to have an exit strategy, right? Before you even enter. So whether it's Google or Microsoft or Apple, Tesla, Nvidia, whatever it is that you're putting your money into, you need to know whether it's a long-term investment or if it's a short-term trade, because that will help you better identify and understand where to get out, right? So that's going to help you answer your question. I'm going to ask you, like, if it's a long-term investment, Google's got tons of potential in the future with the rise of artificial intelligence, cloud computing. I mean, it's literally, these are themes that are just getting started, and they're going to take years to fully develop, fully mature. AI is still in its early growth stages. I would argue cloud computing, cloud servers are also in their early stages of growth. Advertising has matured, right? Google has been operating on advertising revenue for such a long time, but it does have other growth levers that it can pull on. So it has that runway on those other themes that are just getting started. So if you are investing long-term, in my personal opinion, Google is in the shopping list. It's a very strong company. But if you were trading this, then it's a different story. Yes, if you were trading Google, you've got options, you've got other things, then yes, we are overbought. RSI over 86, so is the MACD, so is the L3 banker oscillator. Everything's kind of stretched to the upside. So yes, there is any kind of downside risk is there for Google. We're talking anywhere from 5 to 10% with the support level down to 225 for Google. So those are the things that really you need to discuss and understand before you can make those decisions. Good morning, Caddy. Whatever happened to SMCI? Thank you. And again, everyone, feel free to ask questions, specific questions. The more information you give me, the better and more detailed my responses can be. So if there's any specific stock questions, but also if you can tie in, okay, whether it's a long-term investment, short-term trade, fundamental analysis on that stock or technical analysis, what are the support resistance levels, the more questions, more specific questions you ask, the more detailed my response can be in order to help you. Okay, so SMCI down about 1%. I would say the support level is going to be around 39.46, 39.50s, just a little bit under $50. And we've got a very, very strong resistance that it's struggling to break out of at $46, $47. And yeah, that's pretty much the technical analysis. And we have talked a little bit about the fundamentals. SMCI was one of those stocks that we did talk about back in 2021, 2022. It obviously peaked out in 2023 at $122. Absolutely insane run up. Then we had a lot of accounting issues. We had a lot of different issues with SMCI trading all the way down to $17. And then since then, it has obviously been all over the place, very, very volatile. But this right here would be the higher low and a little bit of a higher high for SMCI as well. So if you do get a breakout, I would say the next resistance is going to be at $63, $64 for SMCI as well. Dilution on BMNR, Ethereum, and Bitcoin are down. Tempelhof, yes, that happened. BMNR, I think, selling more shares and more, debt securities at around $70 to as much as over $80, and as a result, it is lower. And of course, Ethereum being down as much as it is obviously doesn't help the situation as well for a company that is accumulating a lot of Ethereum. So, Bitmain's Ethereum holdings top 2% of supply with 2.4 million Ethereum is what they have. But then, of course, they've got a little bit of dilution also coming in. However, the support is at 57.35. So we'll keep a close eye on that 57 level. If it actually breaks down below this, then obviously 47 is going to be next. But if that level gets held up. And also, I have noticed over the last couple days, there has been a huge wall of supply for Bitmain. It's not been able to break above this resistance around $63, $64. You can see a couple wicks on both days. And if I go over the shorter time frames, it's even more evident that we are seeing this resistance play in. I mean, there's a long wick on these candles here, meaning that every time you get up to those levels, there is a big supply sitting there, and essentially we get this huge flush all the way down to 60s. So it's having a hard time breaking above these levels right now. So support level 57, if you do get that nice bounce back higher, then next target and a retest of that resistance is going to be $63, $64, which right now, as I said, we are struggling to break out of. Rakesh, so you should sell a put option first, and then if you get a sign, you can use them for a covered call. Yes, that is the wheel strategy. That is essentially what we do in the options portfolio, where I'm selling a put, then I'm getting a sign, then I'm selling a call. Sometimes I would do a buy right, where I'm buying shares in the open market and then I'm selling a call against it. Or, essentially if I sell a put and get a sign, then I would hold it for a little bit longer, wait for a very nice green day, and then start selling calls. It's a combination of figuring out, what's the best strategy for trading that stock from an options perspective, right? That's what the options portfolio is for. But yes, you're absolutely right. That's what the wheel strategy is about. Selling a put, getting acquired with those shares, and then selling a call. We've got a whole course around it on how to do it, how to look at the Greeks, how to look at the options chain, how to pick out the right strikes, pick out the right deltas, pick out the right expirations, premiums, return on collateral. There's a lot of math, and of course, a lot of those things we analyze together. For me, Google is now the trim territory, but I don't want out completely. Yes. Again, if you are looking at rebalancing your positions as well, I have talked about this before, and I've actually done a specific video on this as well. There are very few reasons why, in my personal opinion, an investor should really consider selling their stock. And the number one and the most important reason really is if your thesis changes, right? If your thesis actually changes, if you no longer believe the company is performing as expected or they're not executing well, then you have obviously the full right and reason to actually trim your position, or at least, get out of that position if that company is no longer executing. The other thing is, if you need the money, right? If you have an opportunity cost where you feel like, okay, I have a better opportunity now that I want to redeploy this capital into, that's also another reason. And the third is, of course, if you're rebalancing your portfolio, if you feel like, okay, I'm overly allocated in this stock, my thesis is still intact, the company is still performing well, I don't want to exit out completely, but I do want to trim some profits because of how large this position has become as a percentage of my overall portfolio. So then that obviously is a person-to-person analysis, because not everyone's going to be comfortable with their 40% of their stock portfolio in one stock, or 30% of their portfolio in one stock, right? Some people want it to be under 10%, some under 5%, some are comfortable with 50% of their portfolio in one stock. So it really comes down to person, and those are, I think, would be the three primary reasons why it's okay to actually start to sell or trim a position. If your thesis is not intact, if you have an opportunity cost, in other words, you have another opportunity you want to redeploy that capital into, and third is if you're rebalancing straight up. Obviously because of the over allocation. Tesla December call, don't go any less than 500, I think. Yes, 500 is what I have for the covered call. Ray, Tesla call 450, 500 December. Do you feel confident? It's going to have a much higher delta than when I first sold it. So if you come over to Tesla here, let's take a quick look here. And we're looking at December expiration, which is 88 days. And if you're looking at 450 to 500, you're all the way up here, $40, right? It's absolutely insane. These premiums have jumped so much since Tesla's trading at these levels, and now we're looking at a 51 delta for the covered call. So yes, it is much higher. I have a $500 call, which is right over here. It's a 37 delta. It's paying you around $26.50. When I sold it, it was probably 20 or 18 delta, might have been even lower. But those are pretty decent levels for a covered call. However, a 37 delta is still high. I mean, 37 to 50 delta, where essentially it's a coin flip, almost as much as a coin flip. And if you take a look at Tesla here, 450 would be absolutely a no-go for me personally, because it has a very, very high probability it's going to end up in the money. And look, Q4 is just getting started, okay? There's 3 full months left in 2025, October, November, December. That's Q4, which is one of the strongest times for the market seasonality-wise. It is literally November, December it has been very, very strong, right, for the market. I can even show you that in the seasonality, which I will at some point. But $500 is still 16% away. So only 16% for Tesla. That's nothing. If it continues to gain more approvals and we do see a lot of improvements in robotaxis and actually revenue pushing margins higher and substantial revenues coming in, robotics is literally only getting started. So 16% for $500 is very, very close for Tesla. So unless you're okay with those decisions of Tesla getting in the money and you having to sell your shares, then it's fine. But if this is a long-term investment, I would not touch it. I would just let it be. But if you are trading it, then sure, 450, 500 to maximize those premiums is something you could consider because of the higher premiums. I mean, $4,000 for one covered call, $2,500 for one covered call. That's a pretty substantial number. Okay. Thank you. I think it's a long-term investment, but at the moment it seems heavily overbought. Yes, again, it's a fundamentals versus technical dilemma. Technical overbought conditions should not make that decision fundamentally to sell a stock, if that makes any sense. If you bought it for fundamental reasons, for long-term perspective, it's a shift in the fundamentals that should actually govern your decisions for selling a stock. If you bought it from a technical perspective, then a technical factor should govern that decision to selling a stock. So you cannot buy a stock based on fundamentals and then sell it because of technicals, right? But because that would be an overlap of those two things. So hope that makes sense. And let's just come over to some more comments here before we give you a quick overview of what the markets are looking like, and then we'll take a look at it. Cryptos and market breadth as well. If you open a cash secured put on SoFi like $22 and it went to $15, you would just hold them shares, right? Not open a covered call because you could lose even more if the price goes up. So Rakesh, yes, you're obviously down a little bit over $7 in obviously $7 in loss per share. And so the general rule of thumb is to never sell a covered call with a strike price below your cost basis, because that would guarantee a loss. So you always want to sell a covered call with a strike price above your cost basis. So since your cost is, let's say 22, price is already at 15, the chances are you're not going to find anything at $23, $24, $25 strike that's going to pay you anything. The premiums are going to be pretty low because it's very, very far away. So in that circumstance, you're going to have to wait until the price climbs back up a little bit closer to your cost basis, and then you can put strikes, out of the money strikes that are above the cost, unless, again, I don't recommend this for any new beginner trader or investor to go with a strike price below your cost basis, because obviously you can go with 20 strike, which is probably going to have a delta of, let's say, 15 or 10. Low probability that it's going to expire in the money, but there is still a probability that it's going to expire in the money. And if it does, then you are guaranteeing yourself a $2 loss per share in that situation. So you got to really analyze the technicals and fundamentals and, of course, the deltas to make that decision. Okay, do you know of a volatility index ticker that corresponds with crypto? With crypto volatility, like you mean similar to the VIX for the S&P 500? Is that what you're asking? But yeah, I mean, Bitcoin down almost 2%. So is Ethereum down over 6%, trading down to 4,200. We got Bitcoin down to 113,000. They're both coming down to a pretty strong support. So 111, 112,000. We got Ether also trading at a pretty decent support. It's been consolidating sideways. It's been pretty volatile. But that right there would be that support at roughly around 4,000 points on Ether. So Lise, is Amazon making a trading opportunity right now? Why every analyst is talking about BMNR? Well, it's basically because Tom Lee is involved, Peter Thiel is involved, and obviously they've got a lot of clout on Wall Street. Especially Tom Lee has just been, over the last 3 years, as bullish as the markets have been. He's gained a lot of attraction. A lot of people want to listen to what Tom Lee has to say because, look, 72% of the times markets go up. If you are here talking the tape always on a bullish term, then yes, you're going to be more right than wrong. And as a result, it's pretty obvious how statistics work out, right, in the markets. And as a result, there's been a lot of inflow of capital in the Granny Shots ETF as well. And BMNR, since he's the chairman there, obviously that's a pretty big deal as well. So that's why there's been so much coverage on BMNR. Tom Lee's behind it, obviously. Now, coming over to Amazon, before that question here, I would say that we are in this higher high and higher low pattern. So it's kind of bouncing off of that support very nicely around 230. So 230 would be a decent support. In case we break down further, I've got a very strong support down at 219, 220 for Amazon, which in my opinion would make for a better tradable opportunity than what it is right now. It's right now also struggling at that resistance around 235, 237, and a breakout above this, and we're talking all-time highs at 240s for Amazon. Okay, let's take a look here. In your options portfolio that you show in your videos, are they mostly bought calls? Correct. Thank you. So Raul, no, I'm mostly selling options. So that's what I do, is I'm mostly acquiring shares and then I'm selling options. So it's either selling puts or selling calls. And what does that do? That allows me to generate income from the portfolio. So I show that every single week. Every week I do these updates. So if I show you my options portfolio tracker, which is, let me just pull it up very quickly so I can show you exactly what that is. Options portfolio tracker here. So in this, I essentially show everyone what the closing value of the portfolio was. For week number 38, it closed at 292,000 and some dollars here. So I have to kind of update that. But it essentially shows you the portfolio value, and then also at the very top, it shows you the performance summary for 2025. Every year, obviously, I'm keeping track of the performance. So this was 2024. This was the entire performance summary. So you can kind of compare it year over year, how that weekly win percentage has gone up, how the weekly average percentage gain has gone up. And of course, since last year, the portfolio size was smaller, the monthly average gain was 2,400. But for this year, the monthly average gain is over $8,000, right? So it's almost $96,000 per year in gains for the options portfolio. And yes, it is up over $113,000 in unrealized gains for this portfolio. So this is primarily because I'm selling a lot of options. And what that allows me to do is these things. By holding good quality stocks, capital gains allow me to increase the value of the portfolio. Premiums allow me to generate more cash flow. Premiums also allow me to hedge my portfolio in case we get a drawdown, in case we get a sell-off, in case we get a market correction. My portfolio doesn't go down as much as something that may not be hedged. And of course, capital gains are what is generating the alpha in the portfolio at the end of the day, because you really want to maximize upside by limiting downside as much as possible. And that's what this portfolio allows me to do. So hopefully that gives you a bit of an idea. But yes, I'm not buying calls. I'm not buying puts. I'm not betting on the price to go down. I'm essentially selling options. Bull credit spreads options for a small account. So yeah, I mean, that's also a good strategy for smaller accounts to grow and to generate, more and more income. But really, a lot of that growth comes from capital gains. So you really want to maximize for that. With bull credit spreads, yes, it's good for income. But you really want to figure out a way to how to kind of buy shares and sell covered calls, or essentially sell puts to acquire shares at discounted levels. So let's see. Should we be thinking about shifting from tech to another sector of the market, and what should be a safer investment if tech is under pressure and selling off? That's a great question, Mario. And a lot of these tactical rotation strategies, then we kind of, and it's kind of interesting because we had a little bit of a get together over the weekend, and I was talking to, this person that works in risk management at a very, very big sort of, wealth fund. And they were telling me like they have so much churn, they have so many people come and go because, and it kind of gave me a little bit of an insight on how far behind institutions usually are, and they sort of miss a lot of these initial rallies and miss a lot of these initial, stocks because they're working within a framework. They're working within a framework. There's a lot of regulations, a lot of compliance in place. There's a lot of risk management in place. And it kind of made me realize that they are overdoing a lot of these things. They're overcomplicating investing and trading than it doesn't need to be. You're telling me that somebody got fired because they didn't catch Palantir in time and because it didn't fit their framework and in their model. It did not make sense. Same thing with Nvidia. They missed Nvidia, and at the end of the day, like they were chasing that stock higher, and then they've got to explain their clients on why they're buying something that doesn't fit their framework. And so it was very interesting how, obviously this industry operates. And for me, any kind of tactical rotation has to be because I see better value and better opportunity there. Just because one sector is overheated, just because one sector is concentrated is not a good enough reason for me to switch into something else. Because, over the years, we've seen this concentration into technology. We've seen more and more capital flow into technology because technology is changing everything. I mean, it's changing how we do business, how we interact, how we live, how we work, everything. So I, very much focus on tech and growth because I feel like that's where the opportunities are. Not to say there's not opportunities elsewhere. It's just I do prefer tech and growth over many other sectors out there. And so as a result, that's the sector that I'm going to be focusing on, opportunities in this sector. Tesla 525 Jan, so your premium doesn't hit your 2025 taxes. Tempelhof, who is this for? Is it for, the earlier question? Yes, that's a smart way to do it. Pushing it to next year so that it doesn't hit your 2025 taxable year. Is that a death clock? What are you talking about, Noor? Any thoughts on Lulu? We'll take a look at that. That's great insight. Thank you so much. I'm on paper account using your material to practice. Perfect. Okay, so if you have any questions, let me know, and I'm more than happy to answer. Thoughts on October seasonality, bearish, anyone? Let's take a look at seasonality as well, just to better understand what that looks like. And, obviously in the month of September, we are pretty positive, which unlike the historical 4 out of 5 years being down, by an average of about 4%. This month, this year, we are doing very well. But if you come take a look at November has actually been the best month for the market, historically speaking. 76% win rate. It doesn't matter how far back you go to. Since 1900, that's over 125 years. December is the better month. But since 1950s, again, December 74%. And then since 1975, so 50 years, we're looking at almost exactly the same 73.47% win rate for November and December. And then since 2000s, the scales have shifted a little bit towards November, 75% win rate with an average gain of 2%. So this is since 2000, obviously. And take a look. I mean, since the last 24 years, we've only really had 6 years where November was down. And most of those 6 years, 3 were down less than 1%, right? Only 3 times November was actually pretty brutal. That was 2000s, right after the dot-com bubble. And then that was 2008, down over 7%. So if you exclude for the dot-com bubble and the Great Recession, if you exclude for just those 2 years, November has only been down 4 times in the last 24 years. And that too for less than 1%, except for this exception of 07, 4.4. Again, that's the Great Recession. So dot-com bubble and Great Recession aside, November has only been down 3 times in the last 24 years, and that too for less than 1%. So you can see like how strong the month of November has been. But again, just because it's strong in the past does not mean it's going to be strong this time of the year. So market's going to open in about 6 minutes. So hopefully that gives you a little bit of an idea of the seasonality there and what we are looking forward to. Q4, as I said, historically has had a very strong win rate, especially November and December. October has been one of those sort of months where there's a spillover of the September seasonality. So most of the times in the last couple of years at least, we've seen October kind of form the bottom for the market and then recover in November, December, because that happened in 2022. That happened, I think, even in 2021, where October ended up being like this bottom because September was so brutal. And then October was that low for the market. And November, December, we ended up pushing higher. So anyway, NVIDIA slightly down. We got Tesla here up over 1.2%. Palantir slightly down as well. SoFi is essentially flat. I really want to see $30 on SoFi here on the day today. So we'll see if we actually get up there. Yes, VXN and VIX. That similar to that, I'm not sure if there's anything crypto volatility wise. If we have anything, but I'll take a look. I will definitely look into that and see if I can find something. Marcus Caddy lost confidence on PayPal, but I'm positive on it will hit $100 soon. So I actually didn't lose confidence. I want to be very, very clear. I didn't lose confidence in PayPal. It's just that I found a better opportunity. That's all it is. For me, it felt like it was a stock that was not going anywhere, at least right now. But as I said, the company's great. The company's fantastic. And nothing would make me more happy if it actually recovers back to over $100, right? So not losing confidence, but just having better opportunity, right? As I said earlier, there's only 3 reasons why you would sell a stock, right? Number 1 is if your thesis is no longer intact. So yes, if you lose confidence. Number 2, if you find a better opportunity for your capital. And number 3 is if you want to trim and rebalance the portfolio. For me, it was the second reason. It was like I found a better opportunity. And overall, I think PayPal is a great company. It's just the stock seems to be a bit broken right now. So, but I'm still rooting for PayPal. I'm still cheering for it to actually do well and go higher and essentially put everybody back profitable. Jack, just starting to learn options. Your strategy to focus on tech and growth is very helpful. Much to learn. Jack, thank you so much. Appreciate it. I really enjoyed our call the other day. And again, if you have any questions, feel free to message me and email me. And I'm more than happy to jump on more calls so I can help as much as possible. Tom, the Prophet Lee, yes. I would say the Tom statistical Lee, because again, he's playing the stats. He's playing the odds, right? That's what it's about. It's about investing and trading in your favor in the trend of the market and playing the odds, right? That's what you do. If as long as you can play the odds correctly, you understand statistics, you understand math. That's all it is to the market, right? So that's what we're doing. That's what he's doing. That's why it's been successful, because you don't want to bet against the market that is known to go up most of the time. That would be stupid, right? So winner, chicken dinner, BBAI, please. I sold some Tesla to buy crypto regarding next month, not missing this run up. Let's get this pullback. Cash ready this time. Yes, definitely cash ready. Always cash ready. You're selling SoFi after $30, so not really. No, I am just going to hold it because I do think that with the rate cuts, I think SoFi has more runway, and it could be one of those potential 10-bagger opportunities over the long term. So keeping it, and then may sell calls. If I do decide to sell calls, I'm looking at far out of the money. I was actually looking at December calls for SoFi around the $40 level. So if I come over here, and again, this will update as soon as markets open here. So I was looking at December, $40.55. We're looking at a delta of 22, which is a little bit on the higher end for me personally, since I don't want these shares get called away. So I'd be breaking my own rule, but yeah, we'll see. $40, or if the strikes open up to 50, then I may consider 50 for December. Obviously, the premium is going to be lower, but it's something for nothing. And of course, the delta is going to be significantly lower than what we're seeing for 22. Okay. Cash is king, Akar says. Yes, absolutely. During times of distress, during any kind of selling pressure, any kind of recession, correction, bear market, cash is literally king. Because it gives you negotiating power. It gives you a lot of leverage. Deals come knocking and you're able to take advantage right away. You're quick to move. And that is what makes all the difference. And that's why one of our most important preparation strategies is to be cash ready and having that full control over your deals, over your terms. That's what makes all the difference in my view. And even in Berkshire Hathaway's, shareholder letters and meetings, Warren Buffett has always said that I always want to be prepared. Like always want to have a lot of cash ready and be prepared with those opportunities. And you'll see, like this is exactly what we employ here at MoneyVest is your cash exposure is what fluctuates in your portfolio, right? As we know that Berkshire Hathaway's cash exposure has fluctuated. Warren Buffett is known to take on a lot of risk, a lot of aggressive bets when there is times of correction and recession and distress. But then he's also known for tapering off as we are getting into these environments where there is a lot of euphoria and greed. So all he's doing is essentially playing around, fluctuating with his cash exposure, right? It's gone from like less than 10% to 30%, 40%, sitting on hundreds of billions of dollars. Why? Because he understands the game that you only need to strike when there is an opportunity, or else, you're doing what everyone else is doing. So anyway, markets are open, you guys. We got Nvidia down about almost 1%, which is good. I've got 180 calls expiring this Friday. I've also got the 175 calls expiring in October. I really want them to be at least over 95 to 98% profitable before I close them out. And then I've got Tesla here, 432 up over 1.6%. Palantir slightly down. And then we've got SoFi that is also selling off a little bit. So, towards the last week of September, things do start to take a little bit of a turn for the worse historically. If you were to go into the microscopic September seasonality, not just the entire month, but also by day, what time of the month we actually start to see some selling pressure, and it's towards the end of September, which is where we are. If we can weather through this, I think most of seasonality is behind us. And then of course, we'll take a look at October, November, December, moving forward to close the year strong. But volatility here, up almost 4%. Right now, getting up to over 16. Crypto continues to sell off. Ethereum's under 4,200, down over 6% right now, with Bitcoin also down over 2%, trading now under $113,000 as well. Tesla is doing incredibly well. I mean, Tesla is absolutely crushing it right now. No love for Lulu. I'll take a look at that. What is your next Palantir or Nvidia? That's a great question, and I think we have to be very, very, very selective in choosing or trying to decide what our next Palantir or Nvidia is going to be. I can tell you what themes that are going to be very, very important. Rare earth materials, cybersecurity, semiconductor, artificial intelligence, of course, data analytics, quantum computing, cloud services. A lot of these are robotics, autonomous driving, of course. A lot of these are just the waves of the next 10 years. If you can find ideas in companies that are just working aggressively in these sectors and are the ones that are profitable, high margin, good execution, good management, then these are the companies that you want to hold on to for a long time, because they can be real compounders over the next 7, 10, 15, 20 years. So where are we on the 21-week EMA on Ethereum currently? So let's take a quick look on the weekly time frame. If I bring up moving average, let's just do that, 21 EMA. Change that to 21. And we are down at 36.48. That's where we are. And like I said, Ethereum's coming down to a pretty strong support at 4,000. So that would be a support for us to watch on Ether. So SoFi really struggling. So is a lot of these YouTube stocks, retail stocks, I should say. Iron is up over 7%. We got ETHZ up over 3%. Next and DLO up over 2% each. But yes, RGTI down over 8%. BMNR down over 8% as well. We got IONQ up almost 5%. Actually down almost 5%. We got Oklo down over 6%. Open Door also down over 6% right now as well. But Tesla, 434, 435, coming back up to that resistance here. If you come over to Tesla's chart, starting to really break out now at 435, which is very, very good to see. And Tesla continues to surprise us to the upside here. Incredible. All right, everyone. So that's going to be it for today. Thank you so much for joining. I really appreciate you all. Have a great Monday morning and a great rest of your week. Again, link's going to be down below if you're interested in joining us with that additional 30% discount available until September 30th. And also, this entire bundle is 50% off. This includes for all the courses with lifetime access to all the 200 plus videos, now probably 240 plus videos. Includes for fundamental analysis, technical analysis, options trading, psychology of investing, options portfolio updates for each week, as well as stocks and personal finance. So you can see 219 videos right now that you can watch in this if you want access. Again, lifetime access with a 50% off available until September 30th. So as always, drop a like, subscribe, and we'll see you all once again tomorrow morning for the live stream. Take care, everybody.